Welcome to the Fiscal Philosophy YouTube channel. Those of you that follow me closely will know that I've taken an interest in Grab Holdings Limited and bought this stock. Now, just because I have it doesn't necessarily mean it's a good fit for you. But in this video is all about why I like Grab, why I don't really like Uber, and why when it comes down to a choice between the two, for me the answer is pretty simple. Now, this has happened to go up and to the right in about a 45-degree angle since I got in. That's just been a coincidence. It doesn't mean I'm a genius timing the market stock picker, just happened to be the way it went. And much like Uber, this is a mobile app, and it has a ride-hailing component as well as food delivery components, although there is also a fintech component, so you could call it maybe Uber slash PayPal or SoFi, something along those lines. The first financial factor up for consideration would be the margins. So Grab's gross margins have been inching their way upward quarter after quarter and now top 42%. I think there's a good chance that we see it tick possibly even higher than this, in spite of the fact that their rev growth is only going to be about 17%. With better gross margins, a greater amount of that will translate to the bottom line, where they have reached a point of break even to slightly profitable. Contrast this with Uber, whose gross margins seem to be going in the wrong direction slightly, are under 40%. And part of this probably is due to their freight business, which right now during bad times I can't imagine is doing well. The freight market sucks right now, by the way. I work in that industry. And even during the good times, they weren't really raking it in that business. So it seems like it's just there to incinerate money and destroy shareholder value, and not much else. Also, while both companies have historically diluted, the most recent quarters for Grab, the dilution has been pretty flat. Uber's has been a little bit higher, and Grab actually just authorized a $500 million buyback program. Now, it remains to be seen how much of that program they end up using, but it seems that dilution is probably going to be stopping overall for Grab. The balance sheet is the next very interesting point for Grab. So it's a very cash-rich balance sheet that's got extremely low debt. And a business like this that has a lot of cash and almost no debt would be very, very hard to put out of commission, essentially. So from that perspective, I view Grab as maybe perhaps lower risk from that perspective. Now, with Uber, it's not to say that they're going to go broke or anything like that. They do have a good amount of cash on hand and everything, but they do have $11 billion in debt, which exceeds their cash by over $3 billion. And frankly, if they're diluting and they carry a lot more debt, I think that those are factors that impact the value that they can return to shareholders over the at least short to medium term. The next point, and this is an interesting one, I would say this one is actually closer to a tie in a manner of speaking. So, analysts expect Uber to get to just over $3 per share of EPS by 2026. And for Grab, they expect 16 cents per share. Now, of course, yes, $3 is more than 16 cents, but you have to look at that in relation to the share price, since this is a per share measurement, and then come up with your multiple basically from there. And these are actually very close. Grab is slightly cheaper, like just under 22x at today's price, where Uber would be just over. Now, when I started getting into Grab, it was actually closer to an 18x multiple of this. So that just goes to show you how a change in price can really possibly impact your future return. Now, the other thing I want to bring up, though, is which one do we think has more potential growth after 2026? Now, my view is actually that Grab may have more solid growth potential beyond 2026. They are at an earlier stage in their maturity as a business, and the market they operate in, the Southeast Asian markets, several of them developing countries, have a faster rate of per capita GDP growth than the Western markets that Uber operates in. Now, the chances of these two competing is also very slim because Uber owns a pretty large stake of Grab. So they're basically not incentivized to ever actually compete against each other. I also don't think Grab has much to worry about from local competition. Grab is based in Singapore, which is a pretty wealthy country, per capita GDP very similar to the United States. And so they're basically backed by a substantial amount of capital that I don't think can be matched within any of the other countries that they operate in. So without Uber coming in and being a threat, Grab is pretty safe to keep their market share, I think. Funny enough, this is one of the ones that where the analysts actually seem to agree with me. Maybe it's just that obvious, or maybe I should question myself. But what you're getting with Grab is basically the good parts of Uber with a side of fintech, call it SoFi or PayPal, whatever you want, versus with Uber you get, the ride share and the food delivery and some malignant money draining freight business. I think I would rather have the good parts of Uber plus like a fintech thing like PayPal or SoFi, to be perfectly blunt. Now, also, what you get is that foreign exposure. Since it's based outside the US, you're not as vulnerable to US specific economic problems, and you've got that emerging market GDP growth potential, but without being involved in China or the risks associated there. So you kind of get the best of both worlds in that sense. A big problem you run into trying to invest in tech outside the US is a lot of the best values happen to be in China, where people are worried about the CCP and all of that. Grab is based in Singapore, and so you don't really have that same concern. And again, you do still get a lot of the markets they operate in with that juicy GDP growth potential. Some of the countries they operate in include Malaysia, Indonesia, and the Philippines. Now, when you pull up a chart of those countries and their per capita GDP, look at what direction the lines are going. Malaysia really started to take off, it looks like, in the late 80s to early 90s. There have been some setbacks in that number here and there, but overall, the trend line is very strong. Now, the Philippines and Indonesia are a little bit behind, but if you look a little bit later in the 2000s to 2010s, they started to also move up a little bit faster. As these countries continue to modernize and urbanize, I think we're likely to see this growth continue, and thus perhaps some burgeoning middle classes develop in these nations, which those make perfect customers for a business like Grab. Now, Uber could see something similar develop later on in some place like maybe India, but my opinion is that that's going to be a longer road before that starts to actually really pay off in a big way. While India certainly has a growing per capita GDP, and Uber could have some opportunity there, their current per capita GDP is a mere 50%-ish of what they have in Indonesia, which is one of the lower per capita GDPs under the territory where Grab operates. And Indonesia's appears to be growing at a faster rate than India's. So I think Grab will have their emerging markets pay off sooner. Let me know in the comments below if you agree with me that Grab is the better value and the better investment today than Uber. Also, make sure you like the video for the algorithm, subscribe for more, and join us on Discord, link in the description, where we discuss stocks like Grab, Uber, and so forth all the time. Some say it's a cult. Take it easy, everyone. Have a great weekend.